This week we'll start with the FOMC minutes. They came out on Wednesday, and there is a whole section in here. Considerations for slowing the pace of balance sheet reduction. And we were told this in the press conference that there was a discussion that began, and I do expect that probably in May we'll get an announcement on what the new targets will be. Participants began a discussion related to slowing the pace of balance sheet runoff consistent with the committee's plans for reducing the size of the Federal Reserve's balance sheet announced in May of 22. Those plans indicated that in order to ensure a smooth transition, the committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample. In light of the ongoing sizable decline in the balance sheet and the prospect of a more rapid decline in reserve balances, participants agreed that their discussions at this meeting would help inform the committee's future decisions regarding how and when to slow the pace of runoff. No decisions about adjusting the pace of balance sheet runoff were made at the meeting. Participants observed that balance sheet runoff was proceeding smoothly. Nevertheless, taking into account the experience around the end of 2017 to 2019 balance sheet runoff episode, participants broadly assessed it would be appropriate to take a cautious approach to further runoff. And I put this part in green. The vast majority of participants thus judged it would be prudent to begin slowing the pace of runoff fairly soon. Fairly soon. I anticipate that the reserve repo is going to hit zero sometime in June. I don't think they're going to want to wait until that hits zero. I think they'll want to probably start slowing the pace of runoff sooner than that. With the extent of future declines in the overnight reverse repo take-up becoming more limited, further balance sheet runoff will likely translate more directly into declines in reserve balances, potentially at a rapid pace. A slower pace of runoff would facilitate ongoing declines in security holdings consistent with reaching ample reserves. A few participants, however, indicated that they preferred to continue with the current pace of balance sheet runoff until market indicators begin to show signs that reserves are approaching an ample level. I don't know why there are a few holdouts on this. Going back to 2019, that's exactly what they were doing, waiting until a problem showed up. And this is sort of saying, what it's saying, indicators begin to show signs that reserves are approaching ample. In other words, some stress in the repo market, and then you say, aha, we're here. Why wait for trouble to show up? I don't understand that. In their discussions regarding how to adjust the pace of runoff, participants generally favored reducing the monthly pace of runoff by roughly half from the recent overall pace. And right now it's 60 on U.S. Treasuries, 35 on MBS. But MBS is only running off at about 15 per month. So if we say 95 divided by 2 is 47.50, minus the 15 of MBS, that's 32.5. That is half the Treasuries, going from 60 to 30. With redemptions of agency debt and agency mortgage-backed securities expected to continue to run well below the current monthly cap, participants saw little need to adjust this cap, which also would be consistent with the committee's intention to hold primarily Treasury securities in the long run. Accordingly, participants generally preferred to maintain the existing cap on agency MBS and adjust the redemption cap on U.S. Treasuries. So I think what we're going to see is the $35 billion on MBS stay where it is, because the runoff is nowhere near 35, and it won't be until interest rates start dropping, and take the 60 on U.S. Treasuries and bring it down to 30. The 30 on Treasuries and the 15 on MBS would be 45, which is roughly half the 95 that they're at now. So at least they're giving some guidance as to how they're going to cut it. It's just a matter of when. I expect the next meeting they'll probably make an announcement that they're slowing it. Okay, let's see what we have. Staff economic outlook. I don't think we have anything down here. No. The economic projection prepared by the staff. Now this is the staff, not the participants, right? Prepared by the staff for the March meeting was stronger than the January forecast. The upward revision in the forecast primarily reflected the staff's incorporation of a higher projected path for a population due to a boost from immigration. Total and core PCE price inflation were both projected to edge down in 2024, ending the year around 2.5%. By 2026, total and core PCE price inflation were expected to be closer to 2%. In this video, I'm going to argue that we do not have general price inflation anymore. We have specific price inflation, which is not inflation. When you have it in specific sectors, that's not inflation. For it to be called inflation, it must be a general increase in the price level, not coming from specific sectors. I don't think we have an inflation problem anymore. We have a high interest rate problem now. What else do we have? Participants. We've entered the participants' view on the economic outlook. Participants discussed the still elevated rate of housing services inflation and commented on the uncertainty regarding when and how much lower readings for rent growth on new leases would pass through to this category of inflation. A little later in this video, I will contrast Zillow's rent index, which is a very fast-moving index, with where the BLS is, and we'll look at the lags. I think it was Kansas, the Federal Reserve Kansas, put out a paper comparing the BLS with Zillow. With regard to the household sector, participants noted that consumption spending generally remains solid, although many commented that recent readings on retail sales had been soft. We get retail sales this week for the U.S. Participants noted mixed reports about the pace of home building amid still elevated financing costs for developers despite strong housing demand and a limited supply of affordable housing. That is such an important line. Let's read it again because I want to highlight what the thought is here. What they're saying is we got a shortage of housing. Housing costs are elevated. And they said mixed reports about the pace of home building amid still elevated financing costs for developers. I've made this case before that higher interest rates do not encourage more home building. They encourage less home building and they make a bad situation worse. That the way to get housing inflation down is to build more homes. You build more homes by making it cheaper for developers to finance the construction of that building because they got to pay the interest cost on the build out of all of that. So you want them building spec homes. You don't want them building homes just for sale. That they won't build a home unless somebody buys it. You want them building spec homes because that is supply that is greater than the demand. If they build a home for a seller, for a buyer, all they're doing is supplying the demand. You want them to oversupply the demand. That's important. Now, they spoke about high housing prices already, and noting that elevated financing costs are an issue here. Many participants pointed to indicators. Now, this is important too. Many participants pointed to indicators such as higher credit card balances, greater use of buy now, pay later programs, or rising delinquency rates on some types of consumer loans as evidence that the finances of some lower and moderate income households might be coming under pressure. And when they talk about getting inflation down, they say inflation disproportionately affects those at the bottom. And now this paragraph is saying higher interest rates appear to be disproportionately affecting those at the bottom. Can't have it both ways, right? If you're going to have high interest rates, well, then you're going to create one type of problem. If you're going to have high inflation, it's a different type of problem. But it seems contradictory to say that we are fighting inflation because it disproportionately affects those at the bottom. However, the process that we're using to fight inflation disproportionately affects those at the bottom. They're hurting those at the bottom no matter what. Several participants commented that increased efficiencies and technological innovations had the potential to raise productivity growth, which might allow the economy to grow faster without raising inflation. That is exactly true. Technology is deflationary. Participants also noted downside risks to economic activity, including slowing economic growth in China, a deterioration in conditions in domestic CRE markets, a potential reemergence of stresses in the banking sector, or the possibility that the pickup in layoffs could result in relatively rapid rise in unemployment. Many participants pointed to the difficulty in assessing how recent immigration trends would influence the evolution of labor supply, aggregate demand, and overall economic activity. This is new. There hasn't been discussions in the past about the downside to economic growth to this extent. So I can see the conversation in that room shifting to, we are now beginning to cause the next crisis. Maybe this inflation crisis is solved. Higher interest rates aren't going to solve the housing problem. Maybe we should just look past the housing problem. Higher interest rates are affecting those at the very bottom. And we're noting all these other threats to the downside to economic growth. Where are we? In discussing the policy outlook, participants judged that the policy rate was likely at its peak for this tightening cycle. And almost all participants judged that it would be appropriate to move policy to a less restrictive stance at some point this year if the economy evolved broadly as they expected. In support of this view, they noted that the disinflation process was continuing along a path that was generally expected to be somewhat uneven. So they're expecting it to be uneven. It's continuing along the path. We had CPI last week and a negative reaction from the market, which after looking at the categories, I thought, wait a minute here. We don't have general price inflation anymore. We have specific price inflation. This selling is overdone. And I think, given the weekend and some time to think, the market will come to the conclusion that nothing has changed. The cuts that the committee think are going to happen, 3 is going to happen. I think it's a little bit more, but nothing has changed. This is, the tone of these minutes is pointing less to inflation. They're sort of agreeing, yeah, we're going on the right path. It's never a straight line down. It's going to be bumpy, but we're seeing all this other stuff. And that was it. Okay, I've broken it down in categories here. We have food, we have energy, we have goods, and we have services. We look at food, 0.1. We're doing okay there. Some are higher, some are lower. Look at energy. Energy is 1.1, but higher interest rates don't really have an effect on energy. Energy is being affected now more by geopolitical events than supply and demand. So you're going to get this kind of action. This is why the number to look at is core, is without food and energy, because these are volatile components that monetary policy really can't fix. So look at commodities. You have deflation in the category, negative 0.2 in the goods category altogether. That is 18% of the all items less food and energy are basically 80%, and almost 20% of that is in deflation. Let's look at services. Services less energy, services 0.5. That's the problem. But look here. Here is shelter and primary and rent, 0.4, 0.4. And if we look at the weightings of this is 43.8%. Higher interest rates will not solve this problem. You have the same effect in Canada, even a worse effect in Canada. Average home price is significantly higher in Canada, and the housing shortage is even worse. Higher interest rates will not solve it, as we saw in the minutes. Is the high costs, the high interest rate costs are holding back some developers. If you have low interest rate costs, they build spec homes, because it doesn't cost much to carry an inventory as far as a financing cost. So they'll build homes, spec homes, and then hope demand shows up. They don't do that now. You want to solve the problem. Either you have to carve out some really low cost loans for home builders if you're still trying to fight inflation, keep your interest rates high, but have some kind of carve out for home builders saying you can get 1.5% loan rate on your developments. But to have them, the 3-month rate at 5.5, they're not getting that 3-month rate. They're probably going to get a floating rate plus 400 basis points, 500 basis points, or 10, 11, 12%. You want to lower their cost. If you don't want to lower for the whole economy, fine, but you got to lower their cost. Higher rates won't solve this. So this is starting to become specific inflation. Look over here, medical care services and hospital services. Medical care 0.6. If we look at physician services, 0.1, that's nothing. Hospital services 1%, and that's why you get the 0.6 on medical care. So these are labor issues. You simply can't find the amount of support staff you need to operate the hospitals at greater productivity and greater efficiency. This is why hospital REITs or health REITs, healthcare REITs, are having such a hard time. Is the tenants they have are having a cash flow problem because a hospital with 6 operating rooms is only operating with 2 or 3 in use at this time. The others are empty simply because you can't find the nursing staff to staff up those hospitals. This is a labor issue. Higher interest rates are not going to solve the labor issue. And you have transportation services 1.5. That is energy driven. And higher interest rates we know aren't going to solve energy. High or higher interest rates at this point in time will not solve those specific categories. So to be clear, food is not a problem. Goods, you have deflation. In services, your big problem is housing and labor issues when it comes to specific industries. This is not general price inflation. This is specific price inflation. I say job done. I was expecting Canada to cut rates and they didn't. So I am almost I shouldn't say I'm 100%, almost 100% that the next meeting Canada will cut. And US will cut in June. They will announce balance sheet runoff, lower caps for the balance sheet runoff in May, and the first cut will be in June. The ECB looks like their first rate cut is going to be in June as well. The inflation problem is solved. Higher interest rates only create other problems at this point. Okay, money market yields, all well behaved. Capital market yields, there's your volatility, continuing a bear steepener. It was worse on Tuesday. Tuesday was an ugly day. We'll see the effect of that when we look at the chart for TLT. It was an ugly day. Friday was a better day for U.S. Treasuries. Bad day for equities. Curve inversion, record territories here, 634 days. 38 basis points here, 517 days, but it's under 100 basis points because we are getting a steepening here. Canada 131 and 53. Record inversions in terms of the duration of how long they've been inverted. And the sample size is small, but the evidence is rock solid that the economy has never escaped a recession after a curve inversion of the 3-month to 10-year. From the 2 to the 10, soft landings have happened, but never has it happened from the 3-month to the 10. And now we're in a record duration in terms of length, a record in terms of the inversion. So that does change the cost structure in the economy, that we're still sitting there. And the market is pricing for almost no landing. I'm still not there, which is why I just can't get behind a long beta trade right now. Balance sheet down 1.38 billion, nothing running off on the SOMA. So still sitting at 6.85 trillion. Money market decreased by 30 billion. Tax day is Monday. So you have to have cash ready to pay your tax bill on Monday. That could be what is going on here. Retail down 13 billion in both government and prime funds. Institutional down almost 18 billion. Almost all of it in government funds, very little from prime. So it might be because you have tax day coming up on Monday. Next, FOMC, 17 days away. And nobody's expecting anything here. 98.3% that nothing is going to happen. But I think probability would probably be the same probability that you're going to get the announcement on balance sheet runoff. Retail sales in the U.S. 1 day. Moving to Canada, we have CPI in 2 days, and you have the federal budget delivered on April 16th. This doesn't happen until 4 p.m. after the market closes. I got bad news for any successful people in Canada. To date, the feds have announced $38 billion in new spending. New spending, that's already been announced. We don't know what other new spending is in the budget, but this has already been announced. They also have pledged that the deficit won't increase. Where are you going to get this $38 billion? If the deficit won't increase, where are you going to come up with that? They said no new taxes or no tax raises at all on the middle class. So I guess they're going to get it all from the lower income people. Right. The expectation is that there's going to be new taxes announced on successful people. So if you are successful in Canada, you're going to have to pay pretty much for all of that new spending. Going out to December 2018, more than three cuts. Having more than three cuts. Last week there was a 20% probability, almost non-existent now, 6.2%. So the market's sort of thinking, yeah, three is the maximum. 4 or more, again, 6.2%. Fed, the effective funds rate 5.33, still sitting at a 50 basis point lag. Reverse repo, a new low, 407 billion. April 15th was 438, down to 407 billion. That's a drop of 31 billion. At the pace since January 1st to April 12th, and just linearly projecting it out, June 20th will be the zero line on the reverse repo, which means that all balance sheet runoff is purely going to come out of reserves at that point. And that's pretty much what they want to try to avoid, is a rapid decline in reserves. So being that I'm thinking it's June 20th, I don't think they wait till the June meeting to announce anything. I think they announce it in May. The TGA sitting at 672 billion, down 60 billion. The target here is 750, but April 15th, boom, a lot of money comes into the Treasury. Reserves sitting at 3.6 trillion, up 74 billion. Add the reverse repo and the reserves, take out 2.5, because I think that is ample. 1.56 trillion. If they don't slow the pace, they will be there in less than a year and a half, in 16 months. But they're not quite sure where that number is. It could be higher than 2.5. It could be lower than 2.5. And they want to get there slower. So if they cut it in half, well, then this will just get extended out to maybe 2.5 years instead of less than a year and a half. I have been saying for some time that I think the long-run outcome of interest rates and yields in the U.S. is a move to the zero line, simply because of the sheer amount of debt that is out there that you're not going to be able to finance the government. And the government's not going to be able to finance itself, nor the taxpayers afford to pay for it, unless you get your interest costs to zero, because there doesn't seem to be any courage to stop the deficits. So March 2024, CBO's long-term budget outlook. Debt will surge past record levels as share of the economy. The record 166% in 30 years. Deficits will grow rapidly from an already high 5.6% of GDP to 8.5% of GDP by 2054. And every year is just a slow rise. So you have your deficit growing every year, which means you have your debt growing every year. Spending will grow much faster than revenue. Major trust funds are approaching insolvency. The budget outlook is better than last year's, but still troubling. And they show, this is just a synopsis here, Committee for a Responsible Federal Budget. The previous record, 106.1, and they show in 2028 you'll break that record and just keep on going. This is the budget deficits under the CBO's long-term budget outlook. So where are we? 2024. We have a little bit of a dip into 2028, and then budget deficits just continuing to grow. Here is spending over time, and here is revenue over time. Now, this is all based on assumptions. Let's just click over to the CBO report itself. Let's look at their table of assumptions here. And let's look at our revenues here. This is as a percent of GDP. Revenues going from 17.2 to 18.8% by 2054. Individual income taxes making up 10.3. Payroll taxes, corporate income tax, and other tax. What appears to be missing in all of this? Before we answer that, let's look at our outlays. 21, 22, 23, going all the way to 2054 up to 27. These are assumptions that it is made. What is missing here? The next recession. What's going to happen in the next recession? Revenues are going to drop and government spending is going to increase. So you're missing these step functions. Let's go back to this thing that's going on. Notice how smooth the spending is, right? Here was 2020. Notice how this spending jumped right up. So if you're looking at debt, you would have these step functions up. Well, look at this. Where's the recession? We're going to go out 30 years and we're not going to have any recessions at all. First of all, we know that governments don't pay down debt. We can forget about that. There has been a budget deficit and a trade deficit in the U.S. for, 50, 60 years now. I think the last government to pay down debt at any degree was Clinton in the 90s. So you're going up on 25, 30 years without paying it down. If you have budget deficits, you're not paying down the debt, you're introducing newer debt. Where are the recessions? Where's the recessions where your spending spikes and spending spikes? They're not there, because when spending spikes, revenue drops, but that's not in there. So we don't have any recessions and any spikes in spending being forecast for those recessions. What about tax cuts? I guarantee you, first order of business when Trump wins in November, and he will, is tax cuts. That's not in there. So it's going to be a lot worse than what it really looks like. I think I read Goldman's analysis of this, and they had projected even worse outcomes than what CBO has, because they felt that the assumptions were really rosy, were really light based on CBO. But CBO's forecasts here have no reduction in tax rates and no massive increases in spending to fight the next recession, which will happen. This is a big problem, which can only be made worse by higher interest rates, because the interest expense, look what's going on here. This is net interest as a percentage of GDP. 94 to 23, the average was 1.8. It's now 2.4% of GDP. A whole 0.6% of GDP is taken up with interest payments. Rising to 3.1, 3.9, 5, 6.3, 6.3% of GDP. 6.3, I want you to just to think about that for a minute, is just net interest. And this report points out that a third of the U.S. debt is held by foreigners, which is a wealth transfer from the U.S. to other countries over the next 30 years. You simply can't keep these interest rates at these levels. You are going to get massive spending on the next recession. You're going to get massive spending. If you have a Republican government, you're going to get massive tax cuts. If you have a Democratic government, you're going to get massive spending. It won't stop, because that is the second problem we have, is democracy. Democracy has turned populist, and the way that you keep yourself in power is to give stuff away, is to either give a whole bunch of people tax breaks or give a whole bunch of people taxpayer money, one of the two. And no party at this point, I think, really cares about the country. They care about getting power again. If we look at Canada, the Liberal government, in many cases, Canada is much worse off than the U.S., because not only do we have greater interest rate sensitivity, household debt to GDP is the worst for developed countries. We have the worst of it. So the federal government is not even talking about not deficit spending. They're not talking about balancing the budget. They have no plans to balance the budget. It's not even something they would conceive of. Even if you look at a 10-year plan, there is no balanced budget in there. It's just, no, we deficit spend, we deficit spend. We keep raising the amount of debt. So in many ways, Canada is far worse than the US. And if there's a recession on Trudeau's watch, you know he'll open up the taps because he has a socialist government, a socialist party propping him up, and they want to see higher taxes on successful people and more money given to the bottom. Higher interest rates can only create the next massive crisis that has to be fought. So it's for these reasons, I don't think, even if central banks want to keep rates high, I don't think they can. Real rates, all of them greater than 2%. The 5, 7, 10, 20, and 30, all greater than 2% now. Break-even rates have edged up a few basis points as well. Having a look at the Fed funds futures curve, I've moved it out 1 month. So we're July, we're October, we're January 2025. They're clean months because there's no FOMC meeting in these months. 5.25, 5.04, and 4.86, the evolution of the implied rate in the Fed fund futures. That puts Q2 at a drop of 8 basis points, Q3 20.5, and Q4 18.5, or 47 basis points. The market is pricing in 2 cuts versus 3 cuts on the last SEP. So either long the December or long the January Fed funds futures, I think still make sense. TLT this week, there is CPI right there. That is the initial reaction, and then throughout the day it pretty much sold off. So I'll draw that across. You can see that Friday had some help here. TLT down 1.2, SPX down 1.56. The very next day we got PPI. PPI was, I think, 0.2. It was pretty good. Implied volatility 13-week 90th percentile, up from 33. 26th week is 46th percentile, up from 17. We go out and you look at the May 17th, 34 days to expiration, $90 put, $1.49. That's pretty good. I think this over here was an overreaction. I don't think we have an inflation problem, but we have industry-specific or sector-specific inflation. We do not have general price inflation. And if you have general price inflation, higher interest rates can help. If you have specific types of inflation in specific sectors, higher interest rates can't help. You need policies directed at those specific things. So I think the committee is probably thinking, look, as far as the general price level, job done. I do think they are going to cut, as they said they would. So I think that 2 is simply too few. I think it'll be 3 or more, and I think TLT is well supported at these levels. Okay, a lot to look at here. 30-year fixed rate mortgage 6.88, up 6 basis points, and over the week the 10-year Treasury went us up 25. So you have the spread contracting by 19, or at 232 basis points. Mortgage apps for April 5th, the week ending April 5th, up 0.1. We had no housing data last week. This week we get the housing market index, the NAHB housing market index for April. The previous read was 51. It's a diffusion index showing expansion for the HB, for the home builders. Let's see what we get for this read. Building permits on Tuesday, we get building permits for March and housing starts for March. And on Thursday, you get existing home sales for March. Corporate spreads tightening, still tightening. IMF, this was interesting. IMF, 1/3 of private credit borrowers have interest costs greater than earnings. That's their estimate. That 1/3. They're sort of sounding the alarm on just the level of private credit that is out there. 1/3 of it, interest costs greater than earnings. $2 trillion market, mostly in the U.S. This is from Zillow. This is Zillow's rent index. I want to show you something here. Let's get a horizontal line going here. And let's look at pre-pandemic, because this is all pre-pandemic back here, right? And let's just extend that out. Well, there's the rent index. Look at that, it is below where it was pre-pandemic. But you have a lag. Now the Zillow index is only new tenants. The BLS is all tenants, with only they estimate about 20% of their index represent new, but it's all tenants, and Zillow is only new tenants. So because it's only new tenants, Zillow is timelier. Being that it's timelier, we would expect more volatility. And if I back out that line that I drew, let's back it out, you can see that it is more volatile. It peaked, the rent index for Zillow peaked in February of 2022. CBI peaked in March of 23, and PCE peaked in April of 23. That leads me to think there's a 13 to 14 month lag. But Kansas City Fed, in their report contrasting the two, suggested Zillow leads the BLS by 6 to 10 months. If we look at the U.S. Zillow observed rent index year over year is 3.57. In the consumer price index, shelter year over year is 5.65. It was 5.76, dropped to 5.65. In the PCE price index, housing excluding utilities is 5.85, down from 6.13. The fives versus the threes, and if we draw that line in there again, let's go to pre-pandemic and find that particular line. The faster indicator is already there. So what are we waiting for? The lagged effects. Well, the lagged effects will happen. We can see the lag, and even Kansas City Fed says there's a lag, and at least they're in that room when they're talking about rates. The lagged effects of what we see with Zillow are going to take effect. I think you can project that out and say, okay, that'll take care of itself. Higher interest rates at this point aren't going to do anything if you're waiting for the lagged effect. So for these reasons, this is data that's all available to the Fed. This is data that the Kansas City Fed has already done a paper on. I'm sure there's discussion in that room coming from that Federal Reserve District about that evidence. I think it's job done. Okay, let's have a look at gold. There has been some questions of how come the gold miners haven't come along for the rally. In the last month, they have. In the last month, gold miners have outperformed gold. But this hasn't been the case for quite some time, and it is related to the AISC, the all-in sustaining cost. Let's have a look at gold year to date. This is GLD year to date, 13.72%. In the last month, up 7.8%. This red line over here, that was Friday. Gold at one point was up about $60 an ounce and then gave it back all day long, and then even turned negative. And that's because if you looked at the US dollar on Friday went straight up. And so US dollar strength, commodity price weakness, because they're all priced in US dollars. Looking at GDX, year to date 10.47. GDX is a gold miner index. GDXJ is for juniors, up 12.82. Look at year to date gold. Gold has outperformed the miners and the junior miners. Junior are pre-production, 13.72. But look at the last month. Gold miners up 11.46. Juniors up almost 14%. Gold was only up 8%. What you need is the price of gold to go up faster than two things. You need it to go up faster than the increase in the all-in sustaining cost, and it has to go up faster than the decrease in production. Gold output has been decreasing over the last 4 or 5 years. So let's have a look at the all-in sustaining costs here. This is going all the way back to Q1 of 2012, all the way to the end of Q4 2023. And I'm really just going to look at 2019 to 2023, this increase in costs here. Gold over that period of time increased on average 8.9% per year. the all-in sustaining cost increased 6.3% per year. So you think, okay, well, the price of gold is going up faster than the costs. Margins should have increased, right? Problem is, gold production was down by 9.1% over that period of time. So just to put that in context, let's go to the beginning of 2019 and look at a mining company on average. And let's say it has $100 in revenue from selling gold. At that point in time, all-in sustaining costs were roughly about 65% of the price of gold. So let's take $65 off. You have a $35 spread. Now let's increase your gold, our revenues by the price of gold, 8.9%, and let's decrease our selling price by a decrease in volume of 9.1%. We'll get to 99.10. Take your all-in sustaining costs, increase it by 6.3%, you get to 69.10. You have a spread of 30. You went from 35 to 30, which is a drop of 14.29%. You can think of, it's revenue minus it's the all-in sustaining cost. That's not development or exploration. That's just of running that mine. So you're going to have gross operating income decreases roughly on the level of about 14% over that period of time. So that is why gold miners have underperformed the price of gold, but not in the last month. Because in the last month, you've had increases in the price of gold that is overcoming the increase in the all-sustaining costs combined with the decrease in production. So gold miners are going along for the ride. Newmont Mining is one of the largest gold mines, if not the largest gold mining operation in the world, with the most Tier 1 assets. I think they have 10 mines out of their 17 that are Tier 1 assets. I sold the 3750 puts for June. Their degree of operating leverage is 7.2. So when we think about a 1% increase at these levels, where gold is now, a 1% increase in the price of gold, or a 1% increase in their revenues, I should say, will translate into a 7.2% increase in their operating profit. Very nice high degree of operating leverage. Newmont produces gold with a lot of copper. Freeport produces copper with a lot of gold. Look at the combination of these two. Copper is their second largest production. They produce a bunch of other minerals as well, but it's small. You can ignore them. Copper is their next biggest one. By far it's gold. And same with Freeport. By far it's copper, but they produce a lot of gold. Let's look at gold reserves by country. Okay, this is World Gold Council. Click on Gold Hub Professional Investors, click on Data. First one you'll get is gold reserves by country, and it's got a nice little map here. You can hover over it and it'll break down each of the countries and tell you how much gold they have in tons. You can click on gold reserves. It gives you the largest increases. Turkey has increased its reserves. This is Q4 of 2023. That's just Q4. You can have it annually, quarterly. You can choose whatever quarter that you want to look at. China increased by 43.86 tons. We don't have Q1 2024 up. Q1 just ended, 2 weeks ago, so the data isn't available yet. So this is their gold reserves. You can compare that with their currency reserves. You can compare that with the percentage of their reserves that are held in gold. So if we click on North America, 60.72, United States 70%, Canada 0%. Canada has no gold reserves at all. Central Asia, same thing. So you can see how much what they have in gold as a percentage of the reserves, and then of course their total reserves. And the largest increase, Q4 2023, China had the largest increase in reserves. If we look at gold reserves, we can see China increased by 43.86 tons, and their total reserves increased by 141 billion. And then there's a grid down here that gives you each of the countries You can put them in alphabetical order if you want. You can put the regions in you can click on each one. So if we want to look at gold reserve holdings as a percent, we can just look at this one. Let's reverse it. Turkey, 100%. Gold reserves, 36 billion. 540 tons. FX reserves, look at that, 0. FX reserves, 100%. Yeah, you can just look up every country. So I think it's a kind of a neat little tool. Once we get Q1 of 2024, what you're going to see, because we know this has been happening, is a massive increase in gold reserves by China. But I don't know when they're going to update this. So it's, I think if you're interested in this, it's worth bookmarking and checking back every now and then and see when they update this one. Okay, let's check in on the Bitcoin MicroStrategy arbitrage play. MicroStrategy was up 2.82% week over week. Bitcoin basically flat week over week. So MicroStrategy gained against Bitcoin. So that arbitrage play for this week worked against you. But for the 2 weeks now that it would have been out, it is winning. We have the Bitcoin halving event. It is expected this week, expected for April. Binance, their best estimate is Friday, April 9th at noon. It happens every 210,000 blocks. So they look at how many blocks there are, there are to go. The average per day, they extrapolate it out. They've got that data. I don't know where anything sits on this, but if you go to their site, they're estimating, their best estimate is Friday, April 19th at noon, and there's a belief that it's going to have some effect on the price of Bitcoin, other than having some sort of sentiment reaction. All it really does, just to be clear, it does not change the number of Bitcoins that are out there. It doesn't change the number of transactions that are going on. It just lowers the reward to miners. It cuts the reward to miners in half. But this is anticipated. All of this is anticipated. The markets are forward looking. So this is already in the price. It's not as if everyone's going to wait until the halving and go, oh my God, look what just happened. It's in the price already. US dollar stronger. Bitcoin did not have a good day. Okay, SPY, even with the heavy sell-off, we're now down 2.31% from the all-time high. A correction is 10%. Are we going to see a correction? If we are, we've got some more downside to get to. Or are we going to see one of these mini corrections where we get to about 4 or 5% and then off we go? 522.95 continues to be the all-time high. Forward 4-quarter operating earnings, which is 3 quarters in 24 and 1 in 25, 251 from LSEG and 249.52 SPGlobal. Taking the average of the two, considering the SPX closing price multiple, 20.44 times forward earnings. Still an elevated multiple, even after a pullback, an elevated multiple. Surprise factor, so far 29 companies reporting. The surprise factor is 13.5% above consensus. That's probably not going to hold, but still sitting at 13.5 above consensus. For the companies reporting this week, still more cluster Fs here. Sector Spider says 37 companies. SPGlobal says no, it's 35. LSEG says it is 41. I inverted that. LSEG says no, it's 41. I don't know what it is. I'm not about to verify all the 500 companies and go to their websites and check when it is they're reporting. But it seems to me that it can be done. That to have 3 different sites which proclaim to be on top of this, having 3 different numbers, I look at this and I say, well, if you can't get this right, which is fairly objective, how can I believe these? What are you leaving out of this? You know, are there lower estimates that you're simply just not including? I mean, it calls into question all the data when you look at something like this and you say, but this is the easiest thing to verify. It's objectively verifiable, and you can't get it done. There's no consensus on this, and it's so objective. Do you see where I'm going here? How can you have trust in all the other numbers saying, oh, no, the much more difficult numbers to get are right, but the easy ones, oh, well, no. I mean, it calls into question the estimates up here, and are you actually including all the bottom-up estimates? Are these numbers significantly lower? Is this multiple significantly higher? I don't know anymore. Volatility is back, though. Look at that, 13-week volatility, 100th percentile. Highest, we ended with the highest level of volatility way up here. And if you draw this line back, yeah, you can see that you're all the way back to October, November. So in the last 13 months, it is at 100%. 90th percentile if you go back 6 months, and 84th percentile if you go back a year, up from 74. So you have volatility that is back. We have broken the uptrend. If you do your uptrend line here, you have broken the uptrend. We are below that on a technical basis, but we do have some support. It looks like there is some support here, and you can see the slower, the faster moving average. It looks like it has found support because here's the slower moving average here. I'll just draw it straight up. It looks like it found support on the moving average. It has broken the uptrend line, but what technical analysts do when that happens is they draw speed lines. They say, well, if you had this, you now have this. They just draw speed lines and say, see, there's the new line. It hasn't broken that line, and it is right at the moving average. From a correction perspective, because I think we were due for a correction at some point, 2.31 is not correction territory. 10% would mark a correction. 4 to 5% has been typical, and we're at 2.31. But, you know, earnings, if earnings keep coming in above consensus, if the market moves to a closer look at CPI and says, well, hang on a second now, you know, we can see that there's deflation in certain categories, and we don't have general price inflation anymore. We have specific price inflation, and the minutes seem to hint at the Fed being comfortable with this, but being far more concerned, at least the language looked to be far more concerned about economic downside. You could get a rally from this point, a bounce off that moving average, if earnings continue to come in. Or you could have a momentum effect in the correction and say, well, maybe new bids aren't going to come into the market until you get to about the 4 or 5% level. Flip a coin, right? Anyways, that is it for this week. Oh, actually, sorry. What we'll do, because I don't know whose I don't know whose number is right. Let's just look at this one here. It seems to have more companies in there, so maybe it's the more inclusive one. We'll look at that one. Let's see who's reporting this week. Okay, I don't know how accurate this is. Like I said, I'm not about to fact check each line to see if they're true. This week is dominated by financials. Monday you have Goldman Sachs, M&T, and Charles Schwab. Tuesday, a handful of companies, lots of financials here: Bank of New York, Bank of America, Morgan Stanley, Northern Trust, and then some others: Johnson & Johnson, United Health, JB Hunt for some transports, United Airlines. More financials going into Wednesday. You have Prologis, which is a very large REIT, CSX for a railroad, and you got some gambling in here, Las Vegas Sands. Thursday, big one here after the close, Netflix. Let's see what they do. We have Keycor, Comerica, Blackstone, and you got a home builder in there, D.R. Horton. And then going into Friday, Schlumberger, oil services company. You have American Express, Fifth Third Bank, Huntington, Regionals, and P&G is in there. Again, I don't know how accurate this is. You have the link in the description box below, and then of course you're free to use whatever earnings calendar you have.